Zhao was asking, I struggled a bit in identifying neutral zones from the DMI in this week's exercise. Could you go over one or two examples from this week's prep and maybe the reasons for it to be neutral? This is one regarding, okay, so there's two questions. You know, it's probably not appropriate right now because my preps are way more complex than where you guys are. I'm using a lot more things and for more charts than CVAs and PVAs. So no, I'm not going to go through that right now. We could talk about how a structural level might have a bullish or bearish connotation to it versus one that might be neutral. That I think that would be helpful at this time. And you guys should be on the path to understanding those type things. So if you have a fresh break of an area and are able to form a bias, or heck, we got some questions recently around, what about, I typically use a lot of breakout pullback examples. What about a return pullback, right? What about today when crude was accepting and holding back inside this area, right? Well, just because there's a neutral level on the prep does not mean that it doesn't become a bullish or bearish reference once the acceptance picture changes around it, right? But in general, if it's neutral, that means that I'm probably not looking to initiate a trade from the first time we get into that area. For example, back here to the hypothetical one, right? This would become a bearish level. Let's say this is where we're opening. On my prep, this is going to be a bear level. This is probably going to be a neutral level because I'm not interested in just getting long from there on the first touchdown. Spectrum of opportunity, it's just a destination. And so could this become a bullish reference? Sure. If we try and break it down and maybe it fails and we come back and now I get a fresh acceptance picture. Well, it doesn't matter whether it's at 2 p.m. in the afternoon or whether it's now we're about to open for the pit session the following day. Well, guess what? Now this is going to become a bull level based on the recent acceptance change. And this is just a neutral type area where we might go to. But if we have a ton of momentum and the speed of the tape's great and we have time left in the session and we do break here, guess what? This is a bull level, right? We might get a breakout pullback. So, yeah. And as you guys are saying in the chat, this is what's so cool about groups. This is why I love the small group setting of advanced group mentoring. People ask questions that you hadn't even considered that you also have the question for. So, it's the basic stuff, whether or not a level is neutral or whether it's, in my prep in particular, a really green or red, bullish or bearish level. And those are going to depend on the whole narrative that's unfolding. Right now, it's too advanced. I can't get into my preps and everything about them because we're just not ready for that conversation. But we will be. We will be in a couple of weeks. And then another question. This one's regarding risk management. I see many people defining a profit target for the day. How was when you first defined yours? I don't do that, so I don't know about that. Was it just a matter of defining a dollar amount that was comfortable, or did you take any other factors in consideration? Example, you went over your winner sample size, measured them relative to your daily loss limit, and then concluded that dollar amount would be achievable. I see TraderView would be a great tool for that. I am utterly against upside profit targets for the day. I'm entirely against that line of thinking. Not all days offer the same amount of opportunity. Some days offer no opportunity. Some days offer opportunity in which there were several losing trades, and a down day is the proper day, a good day. You traded well. You executed well. Some other joker who broke the rules and had a winning day on that day, you might look at them and be like, well, dang, I need to break the rules. I need to have that winning day. They made money today. I didn't. This is all part of that mental framework conversation around redefining what it means to win. The person who can't stick with their own rules, who can't follow their own methodology until they've achieved mastery in the basic sense of the word, or I shouldn't say it that way, until they've achieved mastery in the basics of executing that methodology flawlessly, and they've maybe earned the right to be more discretionary. I'm at that stage of my trading. Another day, for example, could offer way bigger than normal opportunity, more frequency, more samples of more trades, more really good trades, and you should really knock it out of the park on that day if you're trading well and you keep taking the good setups. And guess what? That should be a big winning day. I recently got onto a student who there was a huge opportunity, and they said, yeah, I did pretty good today. I captured, 15 cents out of this move. No. That's judge yourself based on what was available to you. And so for that reason, I'm out when it comes to setting profit targets. It's also, it's worse than I am even going to take the time to explain here, really. You're setting yourself up for failure when you put expectations for profits on each and every day. And, it's just the exact opposite of the right mental framework that we want to have. It doesn't work. Tony, with a bunch of questions here. I don't know if we're going to answer them all, Tony. We might come back to you if other people, if we aren't running out of questions. When should we rush into the first momentum shift? I find myself getting chopped up many times doing that. I remember you said on a former video, the student who can avoid the impulse is the one that can trade successfully in the end. That's not just like a, wax on, wax off type phrase there, Tony. There's a lot more to that. And it's around continually running impulses through a process, which we're beginning to develop here together this week. The past 2 weeks, I should say. So anyways, for example, he says, today, 9:30 a.m., momentum shift. I took the short because it seemed to tick all the NADR checklist, but I don't know why I also feel a bit uncomfortable to take this early short. So I don't know what market that is. I guess he's talking about ES since he said 9:30. Okay, he's talking about crude oil. So 9:30, I don't know why that is like that. Okay, so 9:30, it's in the middle third of DVA. Not really sure why you would be taking a trade there. Let's look for a different one. 9:47 a.m. short makes me feel a lot better, maybe because the second leg push is smaller than the first one, so I can see some weakening from the buy side. Question. How would you comment on these two trades? So 9:47. Okay, so 9:47, we're talking at least a real developing value area trade location here, right? And by the way, I saw some questions in the room over this past week around what is an upper extreme? What is a lower extreme? Well, it's anywhere close to or beyond developing value area. Close to or beyond developing value area. Close to or outside, right? And on the upper end, that means close to developing value high or above it. On the lower end, getting long, it means close to developing value low or below it. whenever we talk about trades, we want to talk about narrative and all that good stuff. And unfortunately, guys, this particular week has not given us much in terms of composite building. It would have been a gift from the market if we went through a sequence of building a nice little 3-day balance and then got some return pullbacks and breakout pullbacks maybe from that. But we didn't get that. But I guarantee you we will by the time the course is over. So the impulse thing, Tony, is that's about mental framework. And I think we covered that really, really clearly. So you want to go back and watch that video again. I don't know why you were uncomfortable taking the early short. Maybe it's because it was a terrible developing value area trade location. Maybe you should have felt uncomfortable there, right? So I can't speak to that. So he says yes, maybe. So let's go to some more questions from Tony. We'll keep going with Tony. When price is really close to your target, but a couple ticks off of that, what do you do? Sit and wait, or monitor things like order flow to prepare for profit taking earlier than expected? Yeah, you're absolutely right. For those of you who knows what it means, we don't want to be a D for a T. When we're coming, and look, this again goes to the basic line that I said last week: areas, not lines. So if you have a target here and price is coming into it, and it's going to depend, like just seeing this line doesn't translate to the area you should consider it to be. So what I mean by that is, what if the CVA is this big, like we've seen lately with the pickup in volatility compared to older days, right? So it's a small CVA. Well, guess what? This whole freaking space could be considered like an area based on the current rhythm relative to the size of that. However, if we look at the same level and I give you a CVA that's this big, well, guess what? Now it's going to need to get a bit closer to it, and we can we could treat it as an area around this line. So anyways, areas, not lines. And you're absolutely right. When we get close to a destination, ultimately what we're going to look at is for signs of trouble. Maybe we build a poor high into the area and then we wick it and they start to create some excess or something and don't achieve the destination. We can take the profit. Maybe order flow starts to look really, really bad and the shift in the tape comes into play around that area. And so absolutely, we can make adjustments. We don't just sit there and demand that the market ultimately meet all of our areas that we expect it to get to. Is fading an extreme meaning? Okay, so I guess we just covered that already. If we are not in a strong narrative, is it better to only trade confluence areas like CVA and DVA? So let me address that real quick. It's never appropriate to say, I look for confluence between, in my world and in my students' world, we're never going to use the term confluence to talk about anything related to intraday developing value area. It's not a reference. See, I want us to avoid that, because when we talk about confluence, we're going to talk about that from a narrative perspective. This important reference is confluent with this important reference, and we have confluence. And then we're still going to go down to our lower time frame, DVA, and we're going to look to find a way to get into that trade on that lower time frame. Fading an extreme, loose framework, guys, fade an extreme. If you're looking to get long, it can be anywhere near or beyond developing value area low. Basic stuff, loose framework. But when we talk about confluence, we're never going to say, oh, developing value area low is confluent with the composite value area low. It might be, for all intensive purposes, they might be at the exact same tick, but we're not going to call that confluence, because guess what? DVA doesn't go into the factor of whether or not a trade makes sense in terms of narrative and the thesis and the reason behind the trade. So we really want to separate those things. So that's probably good for everyone to hear. So when we don't have a strong narrative, I mean, you know, like your examples, I'm sorry I'm so hard on you here, Tony. If we did have a CVA and you've got developing value area high or low, that's overlapping and right near that area, which means price is probably, you know, either just holding inside it, maybe offering return pullbacks, or just holding beyond it, the composite value area that is. So it's offering breakout pullbacks. So, I mean, you do have a good narrative. So yeah, we're going to move on. If you have follow-up questions, just let me add them. All right, Colin, question about fading extremes when the intraday condition is rotational. Scenario: price is approaching composite value high and we're stalking a short position. Okay, so we're inside of a CVA and we're coming up into composite value high. Price reaches both composite value high and developing value area +2, and we see a momentum shift. Okay, great. Let's draw this out so everybody gets it. We'll use different colors. Make sure it's nice and clear. So we'll put DVA right here. And we will make price blue. And so we're rotational and price goes up here, which is where the, you know, the +2 would be, let's say. Question. Wait. See, that's a second question. What's the question for the first scenario? Maybe you're asking, okay, let me just keep reading here. When fading extremes, do we take the trade opportunity when we see the momentum shift? So he said there was a momentum shift, right? So boom. Do we take the trade opportunity when we see the momentum shift, or do we need to see a pullback or retest of the composite value area, or the, don't call it the DVA-H +2, right? The DVA-H is the +1. So it would be the DVA +2 before getting involved. Colin, you can absolutely get involved from that first momentum shift from the actual extreme. We are, you know, and what might make this trade even better from a scenario would be that maybe recently we tried to break the CVA and we failed back in, right? Yeah, quite frankly, guys, and this will go for, this will be good, a nice little value added, and let older students, which is makes up about 50% of you. I have people who took some old courses from me, and 50% of you are brand new, never studied this stuff before. So for now, for a little bit for you older guys, and when I say guys, it's males and females. I used to teach like you really want to see this, and then you really want to see this, and then you really want to take that trade. We still love those trades, don't get me wrong, but I'm making a little bit of a purposeful teaching shift for this new crop of students here. I want to see more DVA extremes being aggressively faded because I think it will serve you well. And so that goes for new students, that goes for old students. That's a subtle little shift in my teaching style here for this new course, because I think it's really important. I think that a lot of people were waiting on too much perfection and missing some really good trade locations. So now, remember, there's a big difference, Colin and everyone else, between fading that +2 test. Obviously, this makes sense. We have a narrative. What's the narrative? It's a return pullback of the composite value area high. That's the real trade. And what's important here is that the intraday DVA is rotational. Let me draw a little alternate scenario here where it doesn't make as much sense. We'll change our colors back. So let's pretend that developing value looks more like this. And you can probably already guess the way I'm going to draw price. What if price looks like this? And so now we're up here at the +2. We get a momentum shift, right? Same scenario. Return pullback of the CVA. Should we fade the +2 of DVA? And the answer is no, as a beginner. The answer is no. Somebody tell me the two-word term that I'm looking for. It's correct, Colin, but what's the other word? Definitely not law 10. I can see how you could construe that drawing as law 10. Sorry about that. It's just a complex pullback of a return pullback. Yes, we are imbalanced up, but what do we say? All right. All right. It's an established imbalance, guys. So you're hitting around it. You're close. A lot of people saying imbalance, imbalance, imbalance. Yes, it's an established imbalance. Remember how this is example A, okay, and this was example B. Remember, in example A, a lot of people are going to start to see this market as it goes higher here, if you can see where I just drew, as this market attempting to get imbalanced up, and it might seem scary getting short. And it's true. If the market pushes far enough beyond developing value area high, it's in a sense testing to see if it can get imbalanced up. But it hasn't been proven. We don't have the two-word phrase I was looking for from you guys. You really let me down. We don't have established imbalance. Over here on example B, we had this guy, we had this guy, and now you're telling me you're just going to short because we get to composite value high? You're going against the intraday imbalance. You're going against an established imbalance versus fading an extreme of a rotational intraday environment. Both the A and B are the exact same contextual return pullback short opportunity narrative-wise. But remember, DVA is a filter telling us when and where to take a trade or to stand aside. So in Colin, to further give you an example, what do we need to see if we're ever going to get to short? In example B, we're going to need to see this. We're going to need to see this. Then you can fade an extreme after this happens and we see that market start to go more rotational. All right. Colin has another question for us. When fading extremes, do we take the trade opportunity when... Wait a second. I'm an idiot. Okay, sorry. We already read that. Perfect. All right. Sounds like that was really helpful in the chat there for a lot of people. So good. Steve asks, are continuation entry rules valid inside a CVA when the market has trended into a CVA, accepted, and we're expecting a traverse? Absolutely, Steve. So let's draw it for everyone here. We have a CVA. Price is, let's say, imbalanced up from maybe a gap down situation, right? Here's DVA. You get one color this time. And he's saying, we've accepted inside the CVA. We expect a traversal. That's the destination. Is this a valid continuation trade? And the answer is absolutely. Now, is it as good as a break away from a CVA? Remember, usually when we talk about our CVAs, we're talking about the most recent one, right? Because that's where the strongest narrative is going to come from. So for this example, I'm going to say it is the most recent CVA, not just, unfortunately you guys have had to deal with lately a lot of just, all we've got is this old CVA from July and it's like half the size of a normal rotation right now. So that's not easy, guys. I understand that, and I'm very sympathetic to the current conditions for learning basic CVA stuff. Crude was in a balance for months recently, and that would have been a great time to study structural stuff because we just had tons of balance every single day and returned pullbacks all the time and that type of stuff. So, but still, it's good. So yes, you can take that. Remember, we don't, it doesn't make as much sense to say, hey, let's really go for a trend play and let's hold it forever and maybe it'll go to $1 million or the moon or whatever. It is at the end of the day, even though this is an imbalanced intraday play, it's a mean reversion play contextually. So you got to keep that in mind. But yes, I take those kind of trades all the time. As long as everything checks out intraday and it's looking good, looking healthy, we'll use order flow to help with that at times. Yeah, it's a nice continuation play. You got a destination. Stefan, I forget how to say that. Anyways, I feel I'm not sure I understand the concept adequately. What concept? What do you suggest I do? Well, I still don't know. Is it possible to get something like an exam? We could get an exercise to do and get your correction later, something similar to the nightly report, but for more than 5 days. Okay, so he clarifies here just the general concepts I'm teaching. I mean, I'm sorry, man. Yeah, for sure. Like Nick says, I mean, I know it sounds like a cop-out on my part, but re-watch the videos. I mean, these presentations I give you guys on they're not exactly, we are taking a week to digest them, which is better than it used to be. But they're not exactly like, here's an idea and let's look at 50 examples and make sure you've got the concept before we ever move on. This is as we've said from the beginning, this is a very intensive course. So you won't get it unless you're rewatching these videos. So anyways, like some people in the chat are saying here, ask, more questions. From what I've seen, the room is very, very good in terms of lending a helping hand. I mean, freaking Edward in there is unbelievable. I'm going to need to do something special for that guy as a veteran student, getting in there and helping all you newbies and whatnot. I mean, that's just, thank you, Edward. That's really awesome. So yeah, I mean, just reach out, get help, ask specific questions on this Q&A. But other than that, the format's the format. And yeah, awesome. You're welcome. Patrick, Heikin-Ashi bars are difficult to nail the momentum turn with. Got any other suggestions? Can you elaborate on this part of the trade execution? With pleasure. One of my main tools is, and what's funny is some of you may have seen the tweet storm I went on the other day where I was saying like, this is one of the biggest single moment changes I ever made to my trading and all this type stuff. I'll let you know what one of those things were. I think I used the word dumbed down. Well, I have a thing that I call dumb trend line breaks. Now, I'm not talking about trend lines that encap like this, okay? Because that one looks nice, doesn't it? But guess what, guys? Trend lines are absolutely garbage, worthless. This is coming from someone who used to defend trend lines and love trend lines. Sure, is a trend line going to work, when there's a shift in the trend and it just goes the other way? Yeah, it's going to work. Fine. But what nobody tells you or leaves on their charts because they get deleted because they didn't work are the million other times where the trend lines don't work, right? Where's another trend line? Oh, here's one that connected that potential swing high and whatnot. Well, guess what? That doesn't work, right? We could draw a million of these things all over the place. It just never stops. Like, where in the world, it like, okay, we connect this. Oh, that's a significant break. Oh, no, it wasn't. Okay, well, maybe this is it now. Okay, that's a significant break. Oh, no, it wasn't. Oh, maybe this is the real trend line. Okay, there's a significant. Like, come on. The only ones people leave on charts and show on Twitter are the ones that look good in hindsight. So anyways, I'll step off the trendline soapbox here. Let me take a swig of this LaCroix as well. All right. The thing I will use them for, hope I'm not losing my voice, is very much, Patrick, to take a look at shifts in momentum. So for example, see where this arrow is here. Rather than using Heikin Ashi, I will really hug an imaginary trend line and just look for where the momentum shifts. If the choppier a sequence gets, now the flaw with trend lines is still present with what I'm teaching you here. For example, you start trailing this and you're looking for momentum shift. Well, guess what? There is a momentum shift right there. So that would be a long, right? Well, guess what? It doesn't work. So we end up with the same problem we had over here. I forget how I was drawing it, like this or like this, right? They keep all popping up enough to give a momentum shift and failing. The same thing can happen to you here. But I'm just telling you, when a market's trading really cleanly, you can take those kind of direct momentum shift breaks, like I'm talking about, wherever they might occur, that makes sense with the DVA trade location, that makes sense with the narrative, right? That type of stuff. And then if you don't get a pretty one, like this example over here, let me just clear all this out. So for example, we're stalking long, forget where DVA is. We're just talking about price and momentum right now. Boom, we get long right there. It doesn't work. So now what I tend to do is I tend to kind of get a little more medium term with my rhythm, and I tend to use a little more of a medium term trend line, right? I call this a regular dumb TLB, trend line break. But then I will say, okay, show me what you got, market, right? And then what do we see? We see a bit more choppiness. We see this kind of action unfold in here. And then this is where the shift was. So probably at this stage in my career, I use Heikin Ashi much less. I use just, and in fact, I don't sit around drawing these things, right? That's not what I do. I just use my eyeballs. I get a sense of, is the move really clean? So that if there is a little bit of a momentum shift, that is good enough for a signal, or is the momentum dirtier, more bar to bar overlap, to where this same, I'll try and draw it exactly the same, like this. Let's do it again, right? Something like this. It's not an entry signal. Why is that? Oh, I've shifted to needing to see more of a medium term trendline break. The angle does not matter to me, other than what I taught you around, I love to fade a weak, flaggy looking pattern. So if the angle is very shallow, then I like the trade more. So I guess maybe there is something to the angle, but it's not going to, just because it's a steeper angle is not going to scare me away from the trade. That was something that took me a long time to get comfortable with, because I used to trade momentum. I used to trade higher highs and higher lows, lower highs and lower lows, that intraday trend definition. And so it was really tough for me to, like, for example, let's say there was a long opportunity here. That's like extremely difficult to get involved in. And I think I got long here today. I'm almost positive. Anyways, I didn't hold it. I'll go ahead and tell you, I didn't hold it, to the highs or anything like that. But I did catch a good chunk of that early morning. And even going back, because I think this is a really good conversations we're having today, even going back to like Colin's question and whatnot around fading that first extreme or whatnot. if things are getting dicey, if narrative is in real danger, and you're saying, man, this might be too far beyond an area, even if I'm treating it as a loose area, well, then guess what? Be more conservative. Don't take, where's my drawing tool? Come here. Don't take this one. You don't get it, okay? Let's say that the level was right here. Don't take it. If it's breaking down and really going fast through there, just don't do it, okay? If this was the best trade location ever right here, then okay, do it. It's all about narrative. It's all about understanding that acceptance picture and what's going on. But let's go back to example in level A here. Guess what? You didn't get that first trade. It wasn't a trade for you. Okay, acceptance picture changes back in our favor. What's our trade? It's this one. That's the trade. Does it always give us those? No, it doesn't. But a lot of times it does. We just take the trades we can trade. We don't always get them. All right, great questions, guys. Rosie, S&P on September 8th, we were imbalanced low. I guess that means imbalanced down. There was an imbalance pullback that fell within my August 17th CVA, but not at the high. Would it be acceptable to enter short at that point? Looks like 6:57 Mountain Time-ish, so still overnight session. So let's take a look. S&P on the 8th. $6:57 Mountain Time. That's 8:57 on my charts. Okay, so right here. So for me, let's look at my CVA, which would have still been in effect at that time. 8:17, didn't you say? Yeah, you said 8:17. So for me, it's a breakout pullback of the lower edge. I'm not sure why you were saying it fell within your 8:17 CVA, but not at the high. So I'm a little confused. So to me, this trade right here is a breakout pullback for the current rhythm, right? It makes sense. I know the rhythm size is about the same size as the CVA itself, which is difficult. I understand you guys have had some tough conditions here. But anyways, we confirm breakout pullback here and kind of really go back, and you see how this high right here didn't have any excess and it kind of wicks it. That's an up thrust pattern for you even. So yeah, you want to make sure all your charts are, say that CBV. And in fact, I wonder if my chart here on our example workbook, let's see if that makes a difference. No, it's still right there. So anyways, you want to make sure all your charts that you do what I just did, they're continuous back adjusted volume-based rollover. So anyways, you want to talk hypothetical, Rosie? Was your question essentially, was it in the middle area of the CVA? Was it near the upper end? Okay, so it's in the middle. So we kind of already had this question, right? Someone asked about a continuation play. So let's make a big, nice one that we have plenty of room to look at. If you're in balance down, right? And you find yourself here or here or whatever, you can take those plays. You start running out of risk reward and opportunity once you already tag a destination, and maybe you get this, right? Well, now all of a sudden, these trades become a little sketchier because spectrum of opportunity. So that's important to keep in mind. Although Again, I wish we could be a little more basic. I'm not saying it's your fault. It's the market throwing complexities at us real early here in our structural understanding of movement. When the rhythm is crazy, like what I just drew here is a nice rhythm compared to a normal CVA that you're normally going to see. But when you have this CVA and then the rhythm is this, you're going to go to the destination and then you might come back and that might be imbalanced. And, it's tough. And you guys have had to deal with that. And so it's trial by fire here. So anyways, we kind of answered that question twice today around now. You can definitely still take imbalanced entries intraday. And guys, we say intraday. And again, I want to be clear to people who may have jumped in this course because I said it can apply to any time frame. You just have to do your own conversions. When I talk about intraday and we look at a 3,000 volume chart, that could be a 30,000 volume chart for you within the profile of a big balance from a year ago that was 4 months long. Like you can apply this to different time frames. So anyways, so yep, still an opportunity. Nick asks, so if it's pushed far enough to accept outside of DVA, guys, don't get too hung up on a very delineated, very clear acceptance picture when it comes to your trading time frame, DVA. Be loose with it, be fluid, understand where imbalance is established. Other than that, it's rotational and continue to be very loose with that definition. Don't get too hung up on acceptance picture on our trading time frame DVA. Get very hung up on the acceptance picture of your structural narrative-based references and whatnot. So anyway, so if it's pushed far enough to accept outside of DVA, but not rejected developing value area high yet, is it still good to fade the +2? And so that I kind of answered the question before I even finished reading it. Yes, until we're in established, confirmed imbalance, keep fading extremes. And remember, everybody, we're not just talking about DVA in isolation here. The only time it would make sense to fade an upper extreme is when narrative is telling you to fade the upper extreme. So it looks like I'm coming across some stuff in the Q&A here that was like almost real-time commentary based on something I was saying, 30 minutes ago. So Greg, when you say, is the third upswing near reference above? So yeah, we're not doing advanced type setups and whatnot in this course. This is, let's get the basics down, and the basics are plenty good. So David's asking, Merritt, here's a scenario. We break below the CVA, go and balance down intraday. How do you trail a stop when price gets away from DVA? So I'm guessing what you're asking, David, you can let me know in the chat, is really around what if it really gets far away from DVA? And it's almost like you're telling me you want to take some extra measure to protect those profits. And at the end of the day, if the narrative's not done yet, I'm probably not doing anything different. If you are at the point where you're trading multiple contracts, that is, more than a 2 lot, three or more, I really recommend you don't try and get cute with your final core position. So what I mean by get cute is you say, oh, destination's down here and we're trending like this, and all of a sudden it's really extended. Don't say, oh, well, I'm just going to exit my position and there's no way this is sustainable, so I'm just going to put it back on the next beautiful, perfect imbalance pullback, and then, blah, blah, blah. This is really, really tough, and all of a sudden Now it keeps going, and then you want to chase and get back in, and then it comes up, and maybe it's going to be something like this, and you get in, and then you get stopped out further. And all the while, you had a beautiful, easy position because your trade location was way up here, and you didn't have to worry about all this mess. And now you find yourself down on the session because you thought you'd get cute and outsmart, the market in a sense. And trust me, the reason I'm telling you this is because I've been here many times. So try not to get too cute. If you are trading multiple lots, right, 3 or more, you've got that extra scale out opportunity. So if you are going to get cute, do it with an extra scale, right? If this is like the -2 and we really push beyond here, there's like a little pattern type shift there, fine. Like you want to take an extra scale and plan on putting it back higher, fine. But when it comes to like flattening because you're afraid of giving back the kind of windfall profit you've seen in a short period of time, that's a slippery slope. And for me personally, it leads to some bad trading a lot of times because it's like, well, dang it, I should have just left it alone to keep working. The trade's working, and the trade's working really well, and the trade's working fast. There's not much for us to do to try and, get overly cute. I don't know how else to say it. Now, let's give one more kind of thing with that. So if this is developing value, this is the -2, and you're doing this, and all of a sudden, and the destination is here, and all of a sudden you get one of these. Well, guess what? That's different. I might flatten out the whole thing if I start to see a buyers come back in and push it away from there. It's almost like one of the first questions we took today, right? Well, if it gets close enough, we're not going to be overly greedy. Areas, not lines. It's close. We're really extended with our intraday trading time frame DVA framework. Pretty tough. Like this is a really good trade location to kind of take the profits and just be done. That's different. If it's in open space in the middle with more room to go to the destination, I recommend not doing anything. So again, context is king, right? Not all hyperextensions from DVA are created equally. Patrick asking, the spring upthrust pattern mentioned the execution lesson was not discussed. Can you please explain it here? Sorry about that. I don't know how that happened. Let's talk about it. So a spring or upthrust pattern is just the bullish or bearish version of the exact same thing. And so let's take the bullish version, which equals what we call a spring pattern. It's really quite simple. It's where you have on our trading time frame, you have a swing low that gets put in at point A, a retracement, another swing which barely breaches, and I know barely breaches is not a scientific term, but it can't go down here, okay? That's going to invalidate the pattern. And it can't also not breach it, okay? But like something by, I don't know, if you take a percentage of the prior rotation, counter rotation, like let's say a third of it, like don't go more than a third of that rotation size beyond it. I'm just going to give like, that's just me spitballing, okay? It can be just, a couple ticks or whatever, like not far through at all. So let me undo a lot of this. Okay. So what it does look like is it just barely breaches it on that down rotation and then snaps back through it. And as soon as it snaps back through that level, that's the entry. So there's obviously a momentum shift there, but maybe it's a little later than it would normally be because it needs to get back beyond the prior low. That is a spring pattern. low, wick the prior low, spring back through it. That's a spring pattern. The up thrust pattern is the same thing, just upside down. You got to swing high. You go through the swing high by just a touch. Wick it, essentially. That's the signal there. Me personally, I almost use all market orders. I rarely use limit orders because why is that? I'm chasing the last possible moment to get those prices. I don't expect those prices. I don't expect to be able to get a tick better fill. I'm lifting an offer. I'm smashing a bid. And no, it is not that spring patterns can occur anywhere. You know, they wouldn't only be valid if, for example, this was perfectly lined up with a composite value area low. Is that a great place for it to be? You betcha. That's fantastic, right? That makes that overall fading the lower extreme of that composite value area even better play. Giovanni asks, in a market that's been in a trading range for 2 months, like fixed income in Europe currently, where basically every price level has been traded many times over and there are CVAs all over the place, how do you identify meaningful value areas? It's a great question. There's going to be 2 ways to do it, and essentially it's at the end of the day where I think you want to get to, where I'm at and how I'm going to specifically look at a situation like that. I'm probably going to be aware of the big 2-month-long CVA. Huge range, maybe, right? Like this thing's just massive. Like let's pretend this was yesterday, right? But I'm also going to be aware of, so I know that this is the upper and lower bound of the entire balance. So that's like big picture, like really highest time frame. What else am I going to do, guys? I'm also going to come in here and undo all that, but keep my drawing, right? And I'm probably going to come in and find out where there was, a 5-day balance here. There was a 3-day balance here. And I'm going to use those as more of my shorter term context, if you will. So what is that going to do for us? That's going to give us an understanding of where a significant breakout pullback might occur. Might consider some swing positions. You might definitely let your trade management be loose, right? Fully loose leash. If you get that great trade location on a substantial multi-month CVA breakout, I mean, my goodness, right? And then beyond that, you break down from a 5-day balance here, and that's a beautiful trade. Maybe we look to revert to this older, 3-day CVA down here, or even the other edge if we can get it. So it's almost like this dual contextual view that you can have of overall balance with the big picture until that changes, and then smaller balances here and there, not unlike the same thing that you guys have been doing every single day here with, well, if we would have had it, I guess, with a 3-day CVA versus where are we breakout pullback wise or return pullback wise, acceptance picture wise, relative to just yesterday's profile and value area, if value was attached to a good balance. We always want to be aware of where we are relative to the prior day structure and stuff, even if we're in a 5-day CVA. What's more important? The 5-day CVA. What's more important in this case? The 2-month balance. But we still use both timeframes simultaneously to really get that 3-dimensional view of the auction unfolding. Good question. Uh, Gabriel, what long position did I mark in the room yesterday? I mean, I was traveling a good bit of the day yesterday. Was it in S&P? Yes. Okay. So you're talking about this. Okay. So keep in mind that that was just one instance of a trade that I wanted to talk about. Okay, so now we get to the root of the question here. And by the way, why is this level? Oh, sorry, that's the old CVA. We have a new CVA. There we go. So, well, yesterday yesterday we would not have had this. So let's put this like it would have been yesterday. Let's undo this split. Let's undo this merge. And we'll just extend this for a second so it covers our intraday. So there we go. That's what it looked like. The thing is, and I'm so glad you asked this question. I want everyone to pay very close attention here. We're going to have some light bulb moments right now. Gabriel says, as a lot of students naturally do, hey, we're imbalanced down. See, Edward already knows what the takeaway here is going to be, don't you, Edward? We're imbalanced down here. And what Edward is looking at, DP knows as well. It's okay. Here we go. Is this down leg, up leg confirms, imbalance down. Why are you telling me that this could be a long question? A long question. I don't know why I said that. A long opportunity. The answer is this, my friend. You got caught on the little micro and you failed to see how nice the overall more medium-term rhythm was. That's precisely it. If you get your eyeballs 4 inches from the monitor, and you know, it's one of the reasons I have my chart. Let's look at my charts in a different way. And like we're saying, it's not a rookie question at all. This is something that is, you know, in fact, I'm really thankful that you asked the question because, you know, I should probably do a better job of hammering this home for people. So I love the question. So, you know, let's say I want to do my charts more like normal people look at their charts, right? So let's make them look pretty. Candlesticks. Oh, yeah, there we go. Now they're starting to look right. Okay. So what if you're looking at things like this? My goodness, I mean, that's imbalanced down, like, you know. I mean, it's like almost a little downtrend here, you know, that type thing. Look at the loss of vision we get here. What's that medium-term rhythm? No clue. Can't see it. This is a much prettier chart. I love the red with the blue. I love the kind of semi-transparent on the blocks. Like, it's pretty. I genuinely wish I could leave my charts like this, but I will trade like garbage if I leave my charts like this. It's so much prettier. I miss the beautiful candlesticks, but I can't trade good with them because I need to see a lot more information condensed. So we got to change them to these. We got to scrunch it up, right? Maybe not that much. A lot of times I'll keep it something like this. So there you go. Getting a little too caught in the micro and kind of forgetting that overall ebb and flow. You might throw yourself a little zigzag on there. Looky there. The math doesn't lie. All right, guys. That was it for the questions today. I know it's a lot to take in. This week is probably one of the more difficult. This and one other week are probably going to be the most difficult weeks you have in terms of just being like, oh, like there's so much we're trying to put together here. There's so much nuance. But like just there's my answers to a lot of your questions are going to be like basic slap you in the face answers. Like, well, treat DVA like a very loose framework, right? Don't forget rhythm, like the basics. It's kind of like mental framework. You're sitting there, you nod your head. Yes, it sounds good. I get it. And then you don't when bullets are whizzing past your head and you're actually on the battlefield, right? It's tough. So even create some basic affirmations, maybe we won't call them affirmations, but some best practices, some basic things that you can remind yourself to check the medium-term rhythm. By the way, we don't always trade with the medium-term rhythm, but the medium-term rhythm can very much help us see that extra dimensionality, if you will, such as this, to help us see things like that. Okay, guys, great questions today. Enjoyed it. Hopefully you got a lot of value out of it. And we'll see you Monday for a new teaching session. Have a great weekend, everybody. Cheers.